There's much more to bond mutual funds than meets the eye. If you're serious about building a diversified investment portfolio, odds are you're going to be investing in some type of bond fund. But they're not all alike, and how much you invest in a bond fund depends on your risk tolerance, investment objective, and time horizon. In this video, we're going to be covering what you need to know about bond mutual funds. But before we get started, make sure to hit the subscribe button. I want to make sure that you don't miss any of my videos on personal finance and investing. Let's get into it. There are two key concepts that every investor needs to understand before investing in bond mutual funds. The first key concept is duration. Duration is a measure of a bond fund's sensitivity to interest rates. What impact will there be on your bond mutual fund if interest rates go up or if interest rates go down? This is where investing in bond mutual funds gets fun. There's an inverse relationship between interest rates and the value of a bond fund. If interest rates are on the rise, the value of a bond fund will typically decline. The opposite is true if interest rates are on the decline. If interest rates in the overall economy are moving down, the value of a bond fund will typically rise. As a bond mutual fund investor, you need to know and have the right expectation for what could happen to your bond mutual fund if interest rates rise. How great of an impact will there be? What is a good way to estimate how much money you could lose in your bond fund if interest rates start moving up? Well, that's where duration comes in. The duration of a bond mutual fund is going to help you identify the sensitivity of your bond mutual fund to rising interest rates. It's also going to tell you the sensitivity to the fund if interest rates are on the decline. But what's on the top of most people's mind is how much money can I possibly lose? Now let's look at duration. As a general rule of thumb, for every 1% change in interest rates, the value of a bond mutual fund will change by the duration of that fund. Let's look at an example. Let's assume that you have an intermediate term bond fund with a duration of 4. If there's a 1% increase in interest rates, your bond mutual fund would likely decline by 4%. Now that can be a rude awakening for people who have invested in a bond fund seeking relative safety. You could find yourself in a situation where the stock market went up 10%, but since interest rates in the economy moved up by 1%, your nice, safe, and stable bond mutual fund lost 4%. So duration is a key metric to understand before you invest in any bond mutual fund. Again, in general, the higher the duration of a fund, the more sensitive it will be to interest rates. If you made it through the conversation about duration without falling asleep, congratulations. Give yourself a pat on the back. Now we're on to credit quality. Credit quality is a key concept that every bond mutual fund investor needs to understand before you put $1 into a bond mutual fund. Credit quality measures the likelihood of default of a bond issuer. When large institutions like companies or governments want to borrow money, they do so by issuing bonds. But before anyone is going to buy those bonds, they need to know the credit quality. Is the issuer of those bonds at risk of defaulting? Do they have a good credit rating? These are all things that the major credit agencies evaluate. Some of those credit agencies are S&P, Moody's, there are some others in there, and they are the ones who are responsible for issuing credit ratings for these bond issuers. Higher credit quality equals lower risk of default and lower potential returns. Lower credit quality equals higher risk of default, but also higher potential returns. Bonds that are issued by the US government often have the highest credit ratings out there. Now, it's important to understand that if you are investing in a bond mutual fund and it is comprised of bonds issued by the United States, the odds are that you're going to have a very high credit quality bond mutual fund. You also have to remember that that's going to also have the lowest potential return. So the lower potential risk of default equals a lower potential return on the bond fund. Now, the flip side of that is that there are a lot of companies that issue bonds and issue debt, and they may not be in a financial situation that allows them to sufficiently pay back that debt. They might have a very low credit rating. Well, guess what? They're going to have to pay their bondholders a higher interest rate. So you might be able to receive a higher rate of return on those high yield bonds. But don't get tempted by those high yield bonds. Most people are investing in bonds to reduce risk in their investment portfolio that they have with their stocks. But if you turn around and try to reduce risk in your portfolio by adding high yield or junk bonds, you didn't really reduce risk at all. You just increased risk because high yield junk bonds often move in the same direction as stocks. There's a lot more to investing in bond mutual funds than duration and credit quality. And I've written extensively about it on my personal finance site, and I'll leave a link in the description of this video. And lastly, please be sure to subscribe. Your support really helps, and it'll help allow me continue to make personal finance and investing videos for you. Thanks for watching.